Initially, before you jump in, you need to know what effectively you will be up against. Since 2016, I've exclusively only traded small cap US based companies, typically priced between $1 to $10 per share, with capitalization that doesn't exceed more than around $1 billion. The vast majority of big players, for example, institutional investors and hedge funds, typically avoid these markets because there isn't the historic track record of performance like blue chips, and they're just too small to work with. This leaves an environment that is heavily dependent on the volume of retail traders like me and you. And without us, companies usually will just wither away since the majority don't have the financial backing like larger companies to survive even the slightest downturn. Well, even though they are smaller companies, this gives you the opportunities for quick growth and the ability to double or even triple in price in such a short period of time. This also comes with the added risk and volatility to the equation, where the ability to identify when you are wrong and to cut the trade in most instances always has a higher penalty versus a much larger and established stock. So to survive and thrive in this market, it's not a game of who can buy the best company or get in before the next earnings. This is a game of wins versus losses, and even more specific, larger average gains than losses. You will lose, no question. It's a part of the equation, but as long as losses don't define you and you can learn the lesson in each loss, you will be on the road to actually solidifying good habits, routine, and structure that is essential to becoming successful in this niche. In this video, I will show you everything I do and have done to maintain the consistency that is so sought after in this day trading. First things first, which stocks specifically am I looking at throughout the day and where do I find them? This process is actually the easiest part when it comes to your trading system. I personally will only look at companies that range between 50 cents per share and around $10 per share at the higher side. But it's also wise to know that price doesn't dictate the size of a company. For example, if I find a company that's $5 per share, but has 1 billion total shares outstanding, which equals around $5 billion in market cap, that company, even though it's technically cheap in price, won't be able to have the same amount of movement or growth that a smaller company can. I'd rather trade a $10 per share company with 50 million shares outstanding, which is a $500 million market cap. Best way to represent this is to look at companies not just in price, but the float as well. The float is how many shares are available to trade, and the lower the amount, the quicker the moves that can happen, which helps growth. Now, what most won't tell you is that there's a flip side to this. Dangerously low floats have the ability to move so quickly that any possible entry or exit can be inaccurate, or your reaction to these moves can be very delayed. Smaller floats are sought after, but too low can become very dangerous. For me, I don't look at anything below 5 million float. The next thing to keep in consideration is the volume. The volume is the fuel to the fire. There's no question you want volume behind the trade because it helps liquidity, which is the ability to enter and exit smoothly without delays, and also becomes a source of attraction. There's an overlying group mentality when it comes to the small cap trading range. People want to trade where the volume is, so you usually see extreme inequalities between stocks where two companies may have active news reports, but one company has much more volume than the other, and that can become the biggest runner on the day. The more eyes on a company, the bigger the chance is for an epic move to profit from. You want to look for volume above 1 million anytime you're trading in the intraday, which is from the market open to the market close. But as a good tip, you will need to lower that minimum to around 200,000 in the pre-market so you can see earlier moves that develop. Pre-market doesn't bring heavy volume like the intraday does, so you need to open your sight lines further to see moves that would otherwise be hidden from you. So once you have your eyes on a specific company, you need to know how to analyze it properly. The first area of proper analysis is the time frames you choose to look at. Remember, your analysis will only go as far as you can see, so broader ranges like the yearly chart give you more insight into trends and patterns and historical significance, but also you lose the ability to properly see the intraday moves that will determine when you will enter. So why not both? My screens will typically look just like this, 2 frames side by side so I can see both ends of the spectrum. On the daily chart, I want to look for 3 things. Any historical trend over time, any patterns that are recognizable, and also the color of today's candle. The historic trends will help you spot the possibility of a swing setup developing. You'll have much more confidence holding a stock for longer periods of time if the daily chart has shown it has steadily been gaining. Patterns will also help you predict outcomes easier, and you can use that to help your intraday trading. Let's say, for example, there's an ascending triangle pattern developing on a daily chart, and you see the stock is testing resistance. If the move starts to break the resistance, then I know there will most likely be a multi-day run develop afterwards, which I probably can ride or take incremental trades throughout the day. From there, I will go back into the intraday to find the best price to enter. I'll elaborate more on this later. The most important aspect is the color of the candle on the day. It seems so primal, but it has a very important role in the likelihood of large runs to develop. If a company is green on the day, it means that the current price is above the open. And if it's red on the day, it means the current price is below the open. Stocks that fail to maintain green on the day status, especially after news and gap ups, tend to fail very often. Just think logically. Who would want to buy a company that's red on the day and can't maintain price after a very large move? This is usually a death sentence as more potential buyers stick on the sidelines and move towards greener pastures, and the green on the day stock will attract more attention over time. That's why the opening price, commonly overlooked, is so important to watch, and using 2 time frames helps this process. Now to the most important part. How do I plan to attack these positions, especially in these market conditions now? What's important is that there are levels that are hidden to the naked eye, but are powerful to keep in reference throughout the day. First is the opening price, something you have to wait for the day to open to even reference. If I'm watching a stock before the market opens, I'm usually waiting till the market opens to take any action because I don't want to take any preemptive approach before the bell and have a red day flush to develop and screw me out of the trade. That's why I never trade before the bell, especially 5 to 10 minutes prior. Once the market opens, I have to maintain as much discipline as possible to avoid trading out of the gate. This is when I first started, I would lose a majority of my trades in this area. There's a lot of forces going into play right as the day opens. You may have people from the pre-market trying to exit and newcomers looking to play the gap and go. And these stocks create a lot of noise out of the gate. But usually the true direction will show itself within the first 10 minutes or so. So I mainly have 2 options. If the company opens a day and goes into the red, then I wait for the bottom to develop and bounce upwards towards the opening price and look for the red to green move. Secondary would be the company opening in the green, then wait for the nearest resistance of reference to be broken. This is easier to see, but you have to watch out for overstrung moves leading to resistance that can easily be thwarted and rejected. The breaks of any point is where the confusion happens. I need more than just candlesticks to tell me how confidence inspiring this position will be. I'm looking for indicators like the VWAP and EMAs. VWAP, or volume weighted average price, is very important for numerous reasons. For one, I get to see the bias of strength for buyers versus sellers. If I'm looking to play the break and the stock is above VWAP, then I'm more confident into pulling the trigger in that breakout scenario, as buying volume is stronger than the selling volume. If a break setup develops and the stock is below VWAP level, then I will stick on the sidelines waiting for more bullish candles to give me confirmation. Where I get more advanced with this is when I'm looking for possible entry points. Most won't tell you this, but pullbacks and red candles are probably some of the best entry points to buy. I'm looking to get entered into the stock relatively cheap to where it previously has been. So as a rule of thumb, I can't buy any candle that has been the high of the day. This means any entry that I take will always be discounted below the high of the day price. HODs or high of the days are gambles. You literally can't have a single hiccup in between entry and exit, so it's highly unlikely that that situation is going to follow through. Pullbacks to the EMA give you that room to breathe as panic sellers and weak hands grab quick profit and support develops. This is where I find the most comfortable area to pull the trigger. When I pull the trigger, it's a limit only. Can't stress this enough, you need to grab as cheap but effective as possible. Market orders just route to the near seller's price, so depending on the spread can really screw your risk and add risk that never was meant to be there. When you accompany this with stop losses, now you have a setup to protect yourself first and then profit second. I know this sounds backwards, but you need to have this mindset when you trade. Survive, then thrive. Exits are merely a derivative of your risk, but I don't blindly just follow 2-to-1 ratios since I have a very tight risk in certain situations, which will cause me to profit a very, very small amount as well. Set a minimum profit of 2% or higher, just so even in good situations where you have very, very low risk, you don't undercut yourself. I hope you guys enjoyed today's video. Now, I know there's been a delay since the last video. If you guys have emailed me or DM'd me on Instagram, you know that I'm still active in trading and training every single day. But sometimes there may be delay against videos because it takes a long time for me to edit and put things out. I'm pretty much a one-man army at this point. But if you guys have any suggestions on video topics you want me to cover in the future, just comment that down below. If there's any questions on trading in general you need help with, just let me know. I'm going to be active on YouTube now, and I really want to see everybody really get off to a good foot. I mean, this fall season is probably going to be some of the hottest trading we're ever going to have. So I really want to see some people to really grow very, very quickly. There's a lot of opportunity out there. So if you guys want to scale up and go as far as you really want to go, just let me know. And definitely I'll try to help you out any way, shape, or form I can. So hope you guys enjoyed today's video again. This is EatSleepProfit. I'll see you guys next time.